Welcome to part 3 of our lecture on dividends. So we left off in part 2 with the active theory of dividends, where we said dividends need to be managed, or the dividends decision has an effect on the share price of the company or the value of the company. So before we go into this, how the dividend might send a signal, let's first look at how the share price is determined. So some of you might know this already, but I don't think we've dealt this specifically in any of the other modules. So this is company A's share price movement, and let's assume today it's here where the red dot is, so the share price of company A is worth 80 Rand. And let's assume company A is listed on the Johannesburg Stock Exchange. So what determines that 80 Rand? And if I buy the share in company A, who do I pay the 80 Rand to? Okay, so I don't pay the 80 Rand to company A, and company A does not receive any money when I buy the share, because I buy the share from other shareholders. And remember, the only case where company A will receive the cash or where I will buy the shares directly from the company is initially when the company issued the shares. So company A issued 1 million shares 20 years ago and never issued any shares after that. So where does that 80 Rand, or how does that 80 Rand share price get determined? Remember, 1 million shares were issued, so there's 1 million shares out there owned by shareholders. It could be 1 million shareholders owning 1 share each, or it could be 2 big shareholders owning 500,000 shares each, or any combination in between. So if I want to buy 1 share of company A, I have to open a brokerage account or go through a broker, like any bank, and say I want 1 share of company A. And what the broker then does is it looks for another shareholder that already owns a share in company A that's willing to sell a share in company A. So if I want to buy today, I look up the share price in the newspaper, on the internet, and it says it's 80 Rand per share. So I say, okay, I'd like to buy 1 share for 80 Rand. Now the broker needs to find someone willing to pay for 80 Rand, and there'll usually be a spread. There'll be lots of shareholders that's willing to sell for slightly more than 80 Rand, and then lots of people that's willing to buy for slightly less than 80 Rand. And as soon as they find a match between a willing buyer and a willing seller, they match the transaction, and the current shareholder sells at 80 Rand, and I buy at 80 Rand. So if I want to buy immediately, I'll have to offer the price of the lowest current offer out there from a current shareholder. Now, how does the share price, you can see the next day it falls. So maybe some bad news came out of the company, or sentiment changed, or anything, any perception. But people feel there's more people that don't want the share anymore. So in order to get rid of the shares, they have to sell it for less. People are not willing to pay 80 Rand anymore, so the price goes down. And it might reach 75 Rand there. And then they realize, wait, it was not that bad news at all, or some new information comes to light, and people say, no, wait, the share is cheap again, so let's buy it. We want to buy. So more people are willing to buy the share. So in order to get transactions to match, they have to offer more and more and more. Less people are willing to sell, so the price goes up. So what do we call this in economics? Supply and demand. So supply and demand, all the available information drives supply and demand, and if the supply exceeds the demand, the share price falls. If the demand exceeds the supply, the share price goes up. So it's important to realize that this share price here, this 80 Rand, it's not determined by the company, it's not determined by one individual or any bank or any government or anything, it's determined by supply and demand. So the more people that wants to buy the share, the more the share price increases, and the other way around. Now, it's also important to realize that this 80 Rand is not the real value of the company. You can see here there was a long increase in the share price. Now the company might be overvalued. It might actually only be worth 70 Rand a share. Now, how do we determine that actual value? Not the share price or the market value, but the actual value. Remember DCF, discounted cash flow valuations? Well, if the DCF value is 70 Rand, why is the share price 80 Rand? Remember, no one really knows what the true DCF is. It's future cash flows. It hasn't happened yet. So we can only guess. Everyone just makes their best guess, and that's where the 80 comes from. More people think it's worth more than the 70, so the price goes up. Okay, now let's fast forward until they declare a dividend. So before we look at that, let's go back to the notes. We look at the dates, the different dates of the dividend. So there's declaration date. So if we look at our share here, declaration date could have been anywhere before the last day to trade. So let's say they declared a dividend there, where the little hand is. And then the share price drops. Why do you think that could have happened? Remember, declaration of the dividend is the first announcement of the amount of the dividend and when the dividend will be paid. So if the market, that's all the shareholders with all the possible available information that they have, here's that the dividend is going to be 2 Rand per share, but they expected 3 Rand. They're not going to be happy. Remember, the share price already takes into account all the available information on that date. So if they expected a dividend of 3 Rand per share and only receives a declaration of 2 Rand per share, the share price is going to drop. Or if they only expected 1 Rand per share and now suddenly the company announces 2 Rand per share, they might be very pleased, and then the share price goes up because the demand exceeds the supply. But the change in the share price is merely the new information that comes available. It's not because of the amount of the dividend. Well, it is indirectly, but it's because of the expectations that is changed. It also could be that the shareholders expected a 2 Rand dividend, say here's the declaration date, and the announcement was exactly the same as the expectation, so nothing happened to the share price. So on declaration date, the only change to the share price might be because the expectations were different from the actual announcement. And the next date to be mindful of is the last day to trade, or LDT. So up until that date, so that's a date that is announced on the declaration date. So last day to trade is here, let's say at the top of that dark line. So when they announce it, they say the last day to trade is, let's assume it's today, so the 6th of October 2016, and the dividend is 2 Rand per share. So on the last day to trade, at the end of the day, 5 o'clock when the share market closes, then no one that buys the shares after that date will be entitled to the dividend. If you buy the dividend before the last day to trade, then you will be entitled to the dividend. So on the very next day, that's the ex-div date, the share starts trading what we call ex-dividend. So the very next day, that's tomorrow morning at 9 o'clock when the market opens, the share price is trading at ex-div, and anyone buying after that date, from that time onwards, will not receive the dividend. Now, why do you think there's this change? Remember, if you buy before the last day to trade, you will get the dividend. If you buy the next morning and onwards, you won't get the dividend. So, if you buy one share, say the share price moved up to 100 Rand before the last day to trade, you will pay 100 Rand and you'll receive a 2 Rand dividend on the payment date, which is somewhere in the future. So you'll be out of pocket of 98 Rand. If you buy the exact same share the next morning, nothing changed overnight. The only thing is you won't get the dividend anymore. You won't be willing to pay 100 Rand anymore. You'll pay only 98 because you won't be entitled to the 2 Rand dividend that's paid in the future. And then the last date to be mindful of is the payment date. That's basically when the cash payment of 2 Rand per share is made. The record date is just when the shareholders that qualifies for the dividend is recorded in the share register. So not that important. Now let's get back to signaling.